This is what I learned from the financial advisors that I invited to the seminar of Tricks of the Rich. And it's really amazing. I had to do some illustrations or graphics to make it easier to understand because I want to convince my husband to do this and my friends and family because this is a great way to reduce your taxable income and save money, and it's not even too late to do it for the 2018 year. So if you didn't plan well, are you going to owe a big check to the IRS in April and are dreading it? Man, this could help anybody. So I'm going to share it with you in video form. So think about it this way. Here's your taxable income. If you had any write-offs, great, but that is what's left. That is your taxable adjusted gross income. If you did not use the conservation easement deduction, assume the IRS is going to come along and take a third of it, or whatever that chunk is. For ease of demonstration, I'm just going to use about a third of the taxable income goes to income taxes. So the IRS is going to slice off about a third of that. So your taxable income is still the same, but a third of it is paid to the IRS. So this isn't going to change, just for demo purposes. So let's say that same amount of taxable income, if you decide to invest in this conservation easement, so some of that cash you're going to pay to the conservation easement syndicator, or the firm that does the investment. So you got some cash out now. But the cash investment you make, you are very likely to get that 4 to 7 times multiple as a tax write-off. Conservation easement firm makes the donation of the potential future value of that property, which is like a 4 to 7 times multiple of what is paid for the property. So the write-off you see right here is 4 to 7 times your payment out. So I added 5 little rectangles here. So that's a 5 times increase. So that 5-time increase can reduces your taxable income. So I pulled it over to that rectangle, and you see that that write-off lowers your taxable income. So now let's say you still have income taxes coming out at about a third of your taxable income. I mean, if you're lucky, your taxable income will go down significantly enough that you're actually going to get into a lower tax bracket. So instead of taking out a third, maybe it takes out a fifth or a fourth. But this is just assuming that you didn't drop a bracket and you're still losing a third of that taxable income. So there it goes. Let's make the comparison. This was kind of the first scenario with no write-offs. That was your taxable income. That's the cash that went out. Here, that's your taxable income, a lot lower. And your cash went out to make the investment, but a lot less went out to the IRS. So the beauty in this is if you combine those cash out squares, you're either paying a big chunk to the IRS or a small chunk to the CE firm and a smaller chunk to the IRS than you would have otherwise, and you have a tax savings. So the way the math works is it's typical to save 30 to 50% of the value of your investment. So I mean, if you drop into a lower tax bracket, it could save you even more. But let's say you made the minimum investment of $25,000 to the CE firm, you could save like $10,000 to $13,000. And it's early November now. It's not too late to take this deduction for 2018. I mean, especially if you're a renter and don't have a whole lot of deductions for mortgage or property tax or anything, like you need a deduction, and better to put out a little cash now to lower your tax burden and get some cash back. It could be 5 figures or more. Let's say you wanted to put $1 million to the CE firm to shelter that money. You're going to have a multiple of that investment as a write-off, and this gets even smaller and this gets even bigger. So it's really worthwhile. It sounds really complicated, but it really isn't. The math is clear, and the thing about this is you'll know exactly what the numbers are before you agree to do it. You talk to the advisors, they'll tell you, put out this much, this is the property you're going to be investing in, this is what the CE firm bought it at, this is the write-off they're taking, because if they had developed it for oil drilling or something, it would have been worth this. So that's your share of that big write-off when it's donated. That will determine how much less taxes you have to pay. It sounds complicated. It's really not. Watch this again if you need to. And a lot of people kind of shy away from it because it's gotten a little bit of bad press because some people have really exploited the system, and of course, the IRS didn't like that and started auditing and cracking down, but there are still a lot of really great programs going. You just have to make sure to go with a reputable one that's proven, and the IRS is kind of already kind of accepted as, yeah, they do this legitimately. It's not a good reason not to see if you can do it for yourself just because it's been done wrong in the past. Don't let that scare you off. Talk to an advisor and you might be surprised, pleasantly surprised. But I just wanted to get the word out. It's just an amazing thing. Like in the Bay Area, even middle income people can make what the minimum income requirement is to do this. You have to be an accredited investor, which means you make either $200,000 alone or $300,000 as a couple, or you have $1 million of investable assets, which is outside your primary residence. So if you qualify, I mean, there's no reason not to do this. Just work with the good advisors that, I recommend Frontier, just because Frontier are the people who taught me all about it. But go and see if they can help you. I mean, it's worth a call at least. I mean, this could be tens of thousands of dollars in your pocket. So go for it. Do it. Hope it works for you. Thanks for watching. You can check us out in our seminar series at tricksoftherich.com and take care of yourself. Thanks. Bye.